Hello, Warriors. Good turnaround Tuesday to everybody. Hiya, Simon. Yeah, I'm okay. Just use the storm as an excuse for a day off. How you doing, Alexander? And Bran and Paul Penman. Royal, welcome to F.A.C.E. Jordan, how are you? And we have, what's his name? Ryan. Saying good morning.
Huh? I need to say, Dale, there's going to be a storm here Friday afternoon.
Are you going to take a little time off?
Yeah, I want to book a storm, please.
All right. So you tell me this. For anyone looking to trade the yen right now, Ryan, what should they know as far as biases and levels?
Oh, good question. Well, bias at the moment is still for mainly dollar strength and yen weakness. So that's your bias there. Levels pretty clear as you like. 145 at the moment, and up in that 146 highs. You know, it's set itself nicely in a bit of a range.
Okay. All right. And cable, you know, the currencies are having a hard time rallying, you know, especially the euro.
Yeah.
I still think there's one in it. What about you? Is in cable, I'm still paying attention to the possible development of a right shoulder. Here's the daily.
It's going to need a kicker. That's the one thing I'm thinking about. All these pairs, cable, the euro, it needs a kicker because at the moment we're coming through data, we're coming through everything going on, and it's not going anywhere.
How about Paul? Is he going to be the kicker? You know, I saw this guy yesterday afternoon who's been around for a long time, Jerry Castellini, and he's pretty good. And he's saying that we should just wait for our marching orders from Paul on Friday. Do you think it could be that simple? Just whatever Paul has to say is where we're going for a while? And do you think he'll be hawkish?
Yeah, well, given that yields are climbing and a lot of people are putting that down to, you know, higher rates, you know, that's what the Fed have been saying all along, higher for longer. So if he comes out and confirms that, you may see a continuation of what we've seen already in yields and stuff. Because it's not just about whether he tells us something's changed, it's about whether he tells us something's going to continue. And if the market's trading that way, all it wants is a little pat on the back to say, yep, you're right. And it carries on. But game changing, I don't think he's going to say anything game changing. There's nothing, there's no reason for him to say anything game changing at the moment.
Okay. All I know is I'd have a hard time wanting to be long yields looking for higher, at least right now. You know, with this going on and maybe a yen top, I'd have a hard time doing it. Although, you know, TLT made new lows for the break. I've been reading that, you know, we could have some relief on the short end of the curve and not have much or any on the long end. View on that?
Yeah, it's always possible. I think if we're going to see that, we're going to see that after we get over this summer malaise. You know, because what the market will do is for the rest of the year, it will start probably getting into pricing fundamentals, pricing possible cuts to rates. You know, when the market it sets itself up for the last 3 months of the year, the last half of the year, and what's going to happen in the new year, and that's where it'll be important. So, you know, it may be a bit sort of quiet at the moment in terms of all the central bank speakers and everything, but they're going to kick back in September, and then that's when we'll get the lay of the land, so to speak. But in some of the pairs, you know, we're still seeing yields higher, but the dollar's stopped rallying. You look at the Kiwi, Aussie, AD, you know, they're all now finding tougher levels than they did previously.
Yeah, and they're outperforming the continental and the pound. I just wanted to acknowledge what a great level you called in the S&P on Friday of the 4340 level. So that you thought it was significant support looking left
Yeah, there's a
Nice.
few of us down there. Mine was 30. I think Blake's was 25, and a lot of traffic down there.
Yeah. So major bottom or relief rally?
Ooh. Ask me that if we get through 44, 40, 50. If we're through there, it's a major bottom. If we're not, we potentially see the downside again.
Okay. So last week I was talking about a counter trend rally in metals. I was a little early. I got long at 65 and we had one more low. Survived the drawdown. Looks like we're headed there, maybe 23.70, maybe 24. But I think a lot of people are declaring this a very important bottom. And I think it's just another bear market rally. We'll see. Gold has been bringing up the rear and the shares have done really nothing, even the silver shares. So we've had nice rally in the physical silver, but here's an ETF, a silver ETF. This is one of the better looking silver charts, but compared to what silver did, not much on the shares. And we'll see if gold kicks in, not much on the gold miners either. So I'm thinking that, any kind of rally here, just like in the physical, probably has to be faded. And I'm hoping I still get a 100 pip rally in cable. I'm looking at this line up here in cable and 28.5 to 61.8 level. If we could have a little more dollar follow through. What do you think, Kman? Can the dollar continue to pull back? It's really giving it back grudgingly.
It's a bit of a strange one today, Dale. We are seeing currencies that were weaker, like the Aussie and the outperforming all the rest. And that's a bit of a strange one today. I'm thinking there may be some kind of one-off also flows going through, perhaps an M&A, perhaps some dividend payments also, but it's a bit of a strange one. Yen is one thing. We had a higher print on the CPI, and we again kept those mid 146s, which I've been highlighting quite a few times now.
Yeah, you have.
But
here's euro. While we were on the subject, I just thought I'd take a look at it. Breaking some moving averages, Euro Oz. Maybe there's more than a day in it.
Yeah, well, that's the thing. Is it just short covering of Aussie, or is it something a one-off or a couple of days flow or so? But it since this morning, Aussie and Kiwi as well, because Aussie Kiwi doesn't move a lot, have been really bid. Aussie Kiwi is a little bit higher, but no, they've been really bid. So I'm kind of suspecting there's perhaps a one-off also flow going through in there as well, because dollar China is back above 730 or holding, let's say, hovering around the 730 level. As euro couldn't keep its bid. It's really like on the cross side as well. So I think there may be something going on this Aussie and perhaps in the Kiwi as well.
I was looking at the yuan. Kind of looks like, could just be a little flag developing here.
Yeah, that one, and it really held where it had to hold. I think that's 727-ish is a level now. That's where it had to hold, and we still don't know. There's this BRICS meeting going on. We don't know what impact will come out of there. In the meantime, PBOC is fighting against the yuan weakness, but I think fundamentals haven't changed. I'm still looking up in the dollar China. I know I'm not like the one looking at. I mean, there's people looking at the other side because there is around 734, 735. There's decent resistance as well, but
And this was intervention, wasn't it? At the highs?
Yeah, well, they intervened. Then they asked the local banks to go and make the yuan funding more expensive. The 1 month rallied from 2% to 5% or 5.5% at one stage, but that seems to be waning now. Yeah, it's just it's a fight against a too rapid weakening. As I said, I mean they were trapped, right? I think if you say like they want to let the yuan weaken to revamp their economy, I don't think they thought that their economy was going to be hit that hard, and that the developers were going to be hit that hard again. So I think they were trapped in CNH, CNY weakening before they actually thought to let it weaken. So now they have to fight it for a while.
So we have to admit, with the selling in the S&Ps over the last couple of weeks before this week, that what's happening in China is reverberating in our markets. And the commentary I'm hearing is what China's done with the 2 rate cuts is weak. They need to do more. You know, I don't think Xi is impotent. I think if he wanted to do a huge fiscal package, he could do it just like we did. And I think it's by design. And I think China will, you know, let their economy suffer to inflict economic damage and financial damage on the US, because they know that they could. Their population much more used to hardship than ours, and Xi doesn't have an election to face. So let's face it, there's different ways to fight a war, and it doesn't have to be a hot war. I wouldn't be surprised if it's intentional. He knows that all this stuff, you know, maybe they're different than us. They're not going to continue to bail out everything.
That's the big point. You raise a big point there, because you've just said they're disappointed, they're not doing what markets expect or people expect. But that is China. Everyone's expecting them that they should do the same as every other central bank, you know, come with a QE and the big easing and everything. Right. And they've persistently said, you know, we're not going to turn to flood-like stimulus. And so the market is saying, well, you know, your economy is bad, you need to do what everyone else has done. And they're saying,
and you're hurting our economy by you not doing anything.
And they're sticking 2 fingers up and saying, we'll do what we want to do. Thank you very much. And you get on with
it. Yeah, too bad for you.
Yeah.
We'll take the pain to do it.
Who do you trade with? Do you trade with the market trying to push them to do something, or do you trade with China and what they're actually going to do?
B.
Yeah. That's what I'm looking to trade. If the market wants to weaken the yuan and say, yeah, you need to do QE, and China says no, we don't, I'm standing on their side.
Okay. All right. So even if we had another, you know, this could continue to develop and even, you know, pull back to here. These were big levels, right? Weren't they 725, 726 before we had this extension? So, you know, it's possible we go here, but it's not bearish. That type of action is not bearish to me. Looks corrective. So, who else is around on the team? Okay, Steve's around. How are you, Steve? I hear your mic coming on. Maybe not. Okay. Blake, what's new? What do you think of the metals here?
Hey, good morning, Coach. Did you have to grab your lifeboat?
I paddled from my in-laws' house here.
Inflatable. Actually, I think you guys in you know in your part of California got hit worse than some of the coastal cities. Yeah, I mean, all my friends in San Diego, I was like, hey, did you guys, you know, batten down the hatches? They're like, we barely got a trickle. So, you know, it looked like you guys got hit worse than anything. So
we were in the crosshairs in Palm Springs, and it was mainly, the wind wasn't bad, but it, you know, water accumulated pretty good. So anyway,
glad you made it.
All right, thanks, bro.
Glad you made it.
You did a great job in with that interview, having, you know, not even know who Zach is, and just spontaneous, nice interview with him yesterday.
Thank you. Yeah, you know, very nice guy, very well prepared with his Elliott wave charts, with some equities. So he definitely has a good look at of indices or indexes, excuse me. You know, so, you know, I was actually just thinking about, some of the comments that you guys have made, regarding China and, looking at the Aussie. I mean, I gotta point this out really quick. Because everybody, if you don't know this, I think you're probably living under a rock if you hadn't seen like the big triangle in the Aussie. So this is a weekly chart, right?
Yeah.
And this is the importance of the 64-cent level. And we've discussed this in nauseum in the ForexAnalytix community and how important this level was. It's 161% extension of the last couple of weeks right here. You can see this 161% extension right here. So you can see why this and the weekly trend line support and really 64-cent level is big. Now, yesterday we were looking for a move back to where we're at right now, 64.60. 64.60 was the breakdown point. You can see this resistance zone. So we're here. But I have to also point out that the S&P has had a 2% bounce. And this is classic Aussie this year. And I have to say that, we get this massive bounce in equities. And I say massive, I mean, it's 2%. I mean, how far away are we off of the recent highs? Well, off the recent highs, we're only 4% off the recent highs and not very far off the all-time highs. So, 2% rally in the S&P is nothing to sneeze at, after bouncing from these, this key, 43.30, 43.20 level that you and Ryan were talking about. The Aussies bounced less than 100 pips. I mean, we just finally got up a little get up and go today in Europe. I think all the Europeans got in front of their computer and said, well, shit, the stock market continues to recover. We might as well buy something that's like, risk on or whatever. And it is finally getting a little bit of a move, but I would argue that we're probably just bear flagging at this point, and yeah, I mean, the Aussie could, get a little higher, might get up towards 65 cents, but in all actuality, the thing's barely moved. And same thing with the Kiwi. Now, Ryan, by the way, I just want to say great long off these lows, because this is the long-term monthly or weekly 618 retracement is at 59 cents. So, it's also near channel support. So great long off of those lows yesterday. And if you weren't in the ForexAnalytix community, you might have missed that, but Ryan was picking it up off those levels. But look, it's kind of like the same thing as the Aussie. I mean, I don't know if the structure is too different here. We're up against previous support, current resistance. It's around the 60-cent level. That's, where we see resistance, in the Kiwi, so channel resistance, we're right there. So I think we're going to need a little bit more evidence that the equity markets are really going to continue to blast higher. One of the things that was scary to me last night. Well, a couple things I should state out. One of my buddies, he texts me, he's like, oh, the world's going to hell in a handbasket. We're going to just, somebody that doesn't really trade the markets all that much. Do you guys, you see yields? Oh my God, stocks are going to implode. And then I also know he happens to follow a couple well-known bears in the social media space. And I'm like, oh, this is going to squeeze. And we were talking about it yesterday afternoon about, I know a lot of people are gone because it's summer, but we just knew that the S&Ps were going to continue to squeeze higher because all the bears were just getting smashed. I mean, I think it was very, very poor positioning down here, and that's helped created a little bit of short covering. So, now we're in more of an inflection point. I do think that we have some very key events that are happening today. We have, over the next couple of days, we have the BRICS meeting that's starting. Ryan posted a nice little article in the news and research room from Reuters regarding BRICS and what to expect. We also have obviously the Jackson Hole Symposium kicking off here in a couple of days too. So a lot of key events. So I think that in order for the S&P to really squeeze higher, past like this resistance level, maybe around the 4470, 4500 level, you're probably going to need, some further evidence that there's reason to do so. Right now, it seems more like just a recovery rally at this point. So anyway, that's just kind of my initial thoughts. And it's summer, and it's summer. I mean, half the market is gone right now. And the rest of the market, the people that are participating, are really waiting for the latter half of this week to really take a stab at the market. And then tomorrow we have all the PMI data out. You have not only the Eurozone PMIs, you have UK PMIs, and that is tomorrow. I want to confirm that. Let me just make sure I'm on the right.
Yeah.
Like, you have a view on where Bernanke's going to come down, and what kind of statement he might put out Friday?
I don't really. I mean, I would think that the Fed was caught so wrong-footed on with inflation, and everybody understands the severity of what we're dealing with as far as inflation goes, and everybody's just trying to make a case that not only the Fed but other central banks are going to have to just accept higher inflation and maybe adjust their benchmarks for what they see as normal inflation at I don't know 2.5%, 3%, or whatever that is. I'm just not there. I just don't think that I think people are just grasping at straws, like wanting to get the Fed and other central banks to pivot and trying to make up like fantasy stories. I don't see it. I think
They want to go back to the old order.
Yeah. I mean, why should the Fed stop now? I guess if we had a labor market that was imploding and we were seeing weekly unemployment claims at like 350, 400,000 a week, and we were losing a couple 100,000 jobs a month, I would maybe be thinking the other way. But right now the labor market's tight. Yes, there's like economic data slowing and whatnot, but I think their inflation fight is not over. And so I think that if I was a betting man, which I happen to be, then I would venture to guess that the Fed's not, he's not going to roll over and die at this at this Jackson Hole. I think he's going to stay the course and not give the market what they are clamoring for, which is to let everybody off the hook and say, what, inflation's going to stay stubbornly high, and there's nothing we can really do about it at this point. So we're going to say 3%'s okay. 3%'s okay moving forward, and we're just going to change the rules. I just don't see it, but maybe I'll be pleasantly surprised.
The market's still at above 4,400. Maybe if we were 3,800, he might be thinking about it. But I'm sorry. Your comment was what?
The market's still above, S&Ps are still above 4,400. So, if we were 38, maybe he'd be considering it. But
like if financial conditions were so dire and we saw equity markets, just rolling over, and like I said, the labor market was horrible, and
why use the ammo now? You don't need
it. Right, exactly. Like there's no reason. Like there's oh my God, Apple's off its all-time high. We need to adjust monetary policy because of that. I mean, come on, it's I just I'm
don't with you.
I don't see it, but the market has expectations, and they're looking for it, and I just don't know if it's gonna be met. So I think that Friday is going to give us some action, and it's not just the Fed. We're going to have other central bankers there. Harker's speaking. We got Lagarde that's speaking later that day. I think if you wait and you're patient to the end of the week, you're probably going to be able to see some decent price action. So like right now, I'm nibbling around a little bit, just trading kind of small, and I'm looking to be kind of aggressive at the end of the week, especially when liquidity is poor. So and participants are not around. So if we get some good directional moves, I think that they might play like it'll be a Friday trend day type of thing. You see the move. and the move there, then then it pushes you into Friday afternoon. And who wants to get in the way of that? Right. Especially if something significant develops. But anyway, just my thoughts. So
do you think Andrew Jackson rolls in his grave when a bunch of central bankers come up to a place that was named after him?
is that Jackson Hole named after Andrew Jackson?
And President Jackson, yeah.
What was it really? Oh,
Yeah.
no, I didn't know that.
And I think he got into battles about not having a central bank, and I don't know, the using silver was used. So anyway, it's just a little historically ironic.
That is. Well, let's go around and you know, since we got just a few minutes, do we have any data coming out, by the way? I forgot to look for today. We have existing home sales. And by the way, I think the housing data, you know, when you're looking at like existing home sales, is gonna be horrible, right? I mean, we're still in a kind of a, what should I say, Mexican standoff right now in the housing market. I mean, no one can sell. I mean, anybody you talk to that owns a home that has a, you know, a mortgage rate below 3%, no one's selling. Inventory is still tight. So home builders are obviously reaping the benefits here. And they're just building whatever they can build, which makes a lot of sense. So, you know, as I said last week, the housing starts and building permits, those numbers would probably be, you know, sticky, if you will, but existing home sales are going to suck today. But that comes up a little bit later. So we don't have any data coming out here in a few minutes. So Ryan, what are your thoughts going into today's trading? Like, what are you going to be focused on?
Pretty much what you've been saying earlier. You know, we're seeing bounces in things like S&P, Kiwi, and that. It's just a question of how far does it go. If it starts hitting the bigger levels, like we said, S&P up at that 44, 40, 50 area. If it hits that, can't get through, then you know you potentially got your bear market rally. So it's just a question of, you know, seeing the evidence, as you say. Are we going to continue higher? Break the trend that we've seen for the last couple of weeks, or is this just a bit of relief and we're going to refresh and continue on our course?
Yeah, I mean, you know, we had a pretty big rejection thus far, and I have to point this out. So if you look at a weekly chart, you know, a lot of people, what's the guy's name? Dale, your buddy Dave Hunter, you know, calling for a blow off top and, you know, whatever. Yeah. Look, on the weekly charts, we're, you know, clearly creating a lower low right now. So that to me spells more consolidation than anything. I think we need to be looking at the market more like this versus like, you know, blow off top. We'd have to see a lot of things really change. I mean, valuation wise, it's a tough argument to be buying stocks up here longer term from a valuation standpoint. So, you know, when I look at this, it's like, you know, I don't, you know, I unless monetary policy changes dramatically and central banks we're really think that they're going to be pivoting and we're going to be cutting rates for some weird reason at this point. I mean, these highs look pretty significant to me. So that means that, you know, if we see a rally in the S&P and we see a rally back above 4,500, I think that's going to be a nice level to be on the short side, actually, to be perfectly frank here. But anyway, yeah, I think you're right, Ryan. Seeing how the markets react up around this 4,450 level is going to be pretty critical. Kman, what are you thinking going into today?
I don't know what to think anymore after all of that you guys talked about. No, I still think that, you know, I mean, the rates are there, the yields are there in the dollar. I don't see too much of a reason why we should endlessly buy Aussie or Kiwi. Kiwi, I don't know. Kiwi may be a different thing, but then if I look at the dollar CNH, I still think that there's some kind of a flow going through on the Aussie today, why we are higher, because the rest of the dollars is not really lower. Well, dollar CAD just a little bit, but yeah, carry is still doing relatively okay. For me now, I'm actually just trading a few ranges from the short side on the on the euro mainly. I've got a few euro mix short again, but I'm not expecting that much. But I am very curious to know if we get something at all out of the BRICS meeting. And again, my expectations for the Jackson Hole, which is, by the way, as I can read it, not named after a U.S. president.
I was going to confirm that as well, but
my expectations are pretty low.
Dale's making shit up here,
yeah.
So.
Dale definitely does make shit up, but he's got the right to, because he's the coach and he's the godfather of this of F.A.C.E. Yeah.
Oh,
there
it was
you go.
Trapper
Chad
Davy.
says it's Trapper Davy Jackson.
Exactly.
Close.
Well, that was his kid.
But hey, you were close. He did trap on something, so yeah. You were
Yeah,
close.
well, we all know what it's like to be trapped, like you just did to me, buddy. But thank you. I thought it was an interesting guess.
Well, speaking of guests, we have the VIXologist Jim's here. Maybe he's
trying to get in
knowledge about Andrew Jackson and Trapper.
Well,
Trapper.
before you go there, Blake, I want to know what you're doing for your 60th birthday.
It's not 60 for crying out Christmas.
Is it your birthday today, Blake?
Yeah.
Oh,
I got a couple kids with COVID, unfortunately. So
shit.
Well, happy birthday.
Thanks. So I'll be sitting in my office all day. So I'll see you guys there. But thank you. I appreciate it.
Happy birthday to you. Happy birthday to you. Thanks for letting me make up stories on your birthday today. Happy birthday, Blake.
Thanks, buddy. Yeah, it's a big 5-1.
Good.
All right.
Oh,
I'm a
you're a young man.
That's
young
right.
man in your prime.
That's right.
In your prime, yeah.
In my prime.
I'll trade with you.
Big spread.
All right. So I'm waiting for Jim. He said the link that we put up announcing it wasn't working for him. I gave him the same link. So let me just see. Was it why he was having?
Maybe we can find him in the participants.
No, he's not in there yet. So
okay. He's
saying Bitly is blocking that link.
Yeah, Billy's it's weird. That's happened with a couple links, and that's what we use to shorten up links, or Twitter used to. Maybe there's since Elon took over, some things have been working a little differently. Let's just put it that way. So
do we have something else we could
well, we have a Zoom link. So let me see if I can just get you can go right here.
Okay.
And let's see. So here you go, Dale. Maybe you can pass this to him, right?
Okay. Yeah, that's a regular invite.
Yeah, I'm going to put it in our chat here. Okay. So there you go. And then that'll take him directly to Zoom, and and then we can pull him from the attendees. Excuse me.
And Dale, if he's already registered, which I assume he's been on here before, he can just use the chat. He can just use the Zoom code on Skype. Blake's put it on Skype.
Yeah, and Skype, we put it in the Skype chat. Sorry, Dale.
So if he's got Zoom, you can just use that code number, and it will take you straight in as well.
Yeah. So while we're waiting for the VIXologist, which might as well talk a little bit about the VIX here while we are. VIX has really struggled at the 200-day moving average. You can see it right here. We can't get back above 20. We're making lower highs. So volatility is obviously compressing at this point. I'd just looking at the VIX, and something I said last week, we really got to see above 20 to really freak anybody out, to get people excited about any type of higher periods of volatility. We're just not getting that right now. So anyway, volatility is pretty compressed. Looking at the dollar index is still stalling at these highs. I'd be a little, and Ryan, if you're still here, I'm not sure who's still here, but looking at the dollar index, I have to point out, the dollar index is up against channel resistance. It's up against horizontal resistance. We've talked about, the 103.60 level, 103.70, and it's even our bull bear line in the in ForexAnalytix, you know, for the last couple of weeks, you know, this is the dollar index bull bear line, which means, you know, while we're above, you know, 103.75, we're bullish. Below 103.75, you know, you maintain a bearish stance. But if you're bearish the dollar and just looking at it, you know that if we get above like 103.75, 104, you can't really be bearish anymore. I mean, the market's positioned short dollars, still long euros, and that's going to be an ugly move higher. If we start breaking higher, how many people are going to be wrong-footed there? I mean, what do you think?
If you're asking me about the Dixie, I think nothing. I hate that bloody thing. It tells me nothing personally. But yeah, as I said, it's going to take something to break it out. I mean, you know, look around the dollar complex, as we said, euro, cable, well within ranges. Dollar yen is probably the only one that might be on the cusp of a breakout. And you know, one thing we were talking about on the flow show this morning was that a lot of the market is putting put a big target on $150 yen for intervention. Now, again, if you're following us in our chat room, our mate Father Ted, he's running a yen trade weighted index type thing, which gives an indication, you know, what we're looking at in terms of intervention, yen strength, yen weakness. But if we get to 150, it's all going to depend on how we get there. You know, so if the dollar's breaking out and it's a purely dollar move and dollar yen gets to 150, if it's not too volatile, the MOF, Bank of Japan, are going to ignore it. Well, they might jawbone it, but they're not going to be looking to intervene. So you've got to be careful when people put a big fat target on numbers in the market, because they just set themselves up, you know, to get egg on their face.
Yeah. All right. Well, it's 150. You know, a lot of people are targeting it, and I would say channel resistance comes in a little higher or a little less than that at 148. But I wouldn't want to be short while below 145. I mean, you know, establishing new shorts at this point, it's like, okay, well, you know, you have to get below 145 to really, you know, get any type of downside on. But at the same time, you know, you're looking around at the dollar. Let's go like at the euro. I mean, the euro still can't get above channel resistance. Oh, hey, do you have is Jim here?
Yeah,
Jim is here.
now.
Okay, great. All right. Yeah. Hey guys. Well, Ryan, we'll continue these thoughts on the morning edge in about half an hour's time. Have a great interview with Jim, and glad he made it. And Dale, I'll pass it to you. So thanks everybody.
Happy birthday, Blake. I hope it's a great year for you and your family.
Appreciate it.
Thank you, team. You guys. And thank you for exposing me today, Kman. Jim Carroll, how are you, buddy?
Oh, man.
It was stressful, huh? Did I mute you? Jim? Asking you to unmute.
Okay, I'm
all right, there we go. Yeah, and a nice little NFT on yourself. What are you selling that for, buddy?
Nothing.
All right.
Freebie.
All right. So I hear there's some changes in your professional life, in your career.
Yeah, I gotta kind of, I've been advised to keep it quiet for the moment.
Okay.
But let's just say that after Labor Day, I'll be wearing a new jersey.
Okay, so another trade happening on the volatility side. You know, Jim, I'm interested in this. You know, we've had a little bounce in VIX, you know, up to 17 or in that neighborhood. Where would the short vol guys begin to get squeezed?
Well, that's a good question. I've been waiting to get an answer to that myself. Mm-hmm. And can you see my screen now?
Yeah, we have your PowerPoint up there.
Okay. Got it. Yeah, you know, this has been one of those years that has been frustrating again, for people either trying to hedge portfolios or to play the long side of volatility. And, you know, we've got the 2023 wall of worry. You know, we've still got a war going on in Ukraine. Meh.
Yeah.
We had the regional banking crisis in March.
Yeah.
Bank of Japan. Collapsing credit in China.
Yeah.
You know, we just keep shaking this stuff off, and you know, the market bounces around a little bit. We take a little air out of it, and then we put the air back in, and as a result, you know, you've been much better off on the short side of volatility most of the year than you have been trying to play the long side or even hedging, and I'll come back to that.
Okay.
You know,
So
if
I mean,
you
really,
look-
the story hasn't changed. It's been this way for a long time. And it makes me think, though, that maybe recency bias about it working for so long, actually, people have even more confidence of being short vol. That
Yeah,
maybe
I
it's
think
a very
there's
big, heavily positioned. Everyone's on the same side of the boat selling vol.
well, you know what happens when everybody's on the same side of the boat, and we'll find out at some point in time. But I think there have been a couple of factors involved.
ODTEs.
Well, you know, zero DTEs is a controversial topic. There very clearly has been an increase in, you know, what I'll refer to as the institutional use of shorter dated options. You know, Dale, you understand options well enough. If you are a premium seller, right? If you're collecting premium, and you know, once upon a time, you and I are old enough to remember when you could only do that once a month.
Yeah.
And then you could do it once a week, and now you can do it every day. So if you're a seller of premium, a collector of premium, and you could do that every day, then you might be inclined to take advantage of that. So clearly that's been one factor driving the supply of volatility. The other thing driving the supply of volatility is the whole, and I use this term advisedly, structured product complex. There's an ever increasing number of strategies available to investors, including retail investors, that involve, you know, some package of options. And
for a
at
hedge.
least, for a hedge, or for, you know, as an example, innovator ETFs, who have been a huge player in this marketplace, recently launched an ETF that has zero downside. You know, it basically is a 2-year product that offers, you know, a portion of the upside in the S&P with a cap at 0 on the downside. You know, how do they do that? Well, they do it using option structures. And to the extent that investment advisors and retail people say, give me some of that, I'll take less than full upside in exchange for 0 downside. You know, that means that that innovator is out in the market on a regular basis,
selling
buying
premium.
and selling premium, but yeah, in part selling premium, right? They're selling calls to buy puts.
Right.
And so I think there's been a large influx over the past few years of structured products in the options market, adding to the flows, adding to positioning, and in what has been, notwithstanding, you know, little blips here and there, a relatively benign environment. You know, that flow is going to, you know, put pressure on implied volatility.
That flow also, the new innovations, which, you know, from innovation, also make the trade of short volatility even more crowded, don't you think?
Clearly, and you know, the question is, you know, how deep is the market? And the market's pretty deep. You know, you're typically looking at SPX or SPY options that are being used to construct these products, and that is the deepest, you know, of the option markets. You know, so you know, they're trying to be smart about what they're doing, but you know, clearly, it is adding to the supply of volatility in this market. You know, it's sort of keeping downward pressure on implied volatility.
Okay.
Is that
Yeah.
making it harder, you know, to be on the long side? You know, sure, at least to a certain extent, that's making it harder.
Yeah.
And
It's
and,
crowded,
you know,
Jim. I mean, I guess my whole point is it was crowded before, and with these new products, and actually one of our attendees is asking, is that an ETF, that innovator fund, or do you have a symbol for that?
you know,
You don't?
try to remember what the symbol is. I'd have to go scrounge it up.
Anyway,
But
is
if
it an ETF?
Yes, it is an ETF.
All right, so just spell innovator, buddy, and you'll find it.
And you know, so if you look at where VIX has been over the last, you know, 3.5 years, you know, certainly from October of 2022, the
Yeah.
trend has been down. We had a little spike in March, but you know, the
Right.
trend has been down. And
Right.
you know, in the grand scheme of things, you know, I like to sort of zoom out and look at long-term averages. And if I say that a 1-year average of VIX above 20 is kind of a, you know, line in the sand, higher volatility regime and lower volatility regime, you know, we're on the cusp of leaving what has been a higher volatility time period and moving back to what would arguably be a lower volatility time period. Obviously, something could cause, you know, volatility increase, but you know, we're right on the cusp given the decline in volatility over the last year or so.
So that moving average comes in at 20, so that's going to be a big test should we get up there.
You
Back
know,
above that moving average.
It's you know, it's for me, it's kind of a mile marker. It's something I pay attention to. You know, it's not a bright line that things are going to be great if the red line goes back below 20. But certainly during those periods when that red line is above 20, we you know, have seen and are likely to see increases in volatility.
Okay.
You know, looking at the year from the standpoint of the term structure using the SIBO volatility indices, you know, the high was on March 13th, you know, in the aftermath of Silicon Valley
SVB.
Bank collapsing, right?
Yeah.
But the year-to-date average, you know, is we are right now pretty much in line with the year-to-date average. And with 9-day and 30-day VIX both below 20, 3-month VIX below 20 right now. So, you know, we're in a relatively calm state. Remember that a 17 VIX, if you use the rule of 16, implies that the volatility market thinks we could see SPX daily moves of about 1%. And we'll come back to that. But, you know, so if people think that volatility might be too low or too high, you know, the current state of volatility is saying we could expect to see plus or minus 1% moves on a daily basis in the S&P, which has not been what we're seeing. We've been seeing lower moves, and I'll come to that. High low for VIX over the years, you can see that again, the average for this year is a drop and the range is relatively narrow. Volatility of volatility, the average has been dropping and the range has been narrowing. Looking at the VIX futures, and what I call VX30 is a constant maturity using the front 2 months and trying to pin, a 30-day picture of what the VIX futures are telling us. And again, from last year, we've seen the average drop, we've seen the range tighten. So the market is saying things are okay, things are less volatile. In terms of how the VIX is responding, the story in 2022 was that, the VIX was just not responsive. It was broken, quote unquote.
Right.
And, whether that's true or not, we are continuing to see a relatively muted response. So, this is normalized to a 1% down or up move in SPX and the point change in VIX, since it is a percentage to begin with.
It's been cut in half from 2020.
Yeah. So, it's from 2021.
Okay, yeah, all right, yeah.
The aftermath, 2020, you would think, but,
Yeah, 2021. Yeah, the VIX never got over 38 during that whole 30%,
Right.
20% decline. Yeah.
Right. So the responsiveness of implied vol to moves in SPX, it does move, but the range is relatively narrow, which goes back to, the idea that the volatility is well supplied.
Okay.
Now, the story is realized volatility. The S&P has, just not had a lot of realized volatility. The range this year is way down from last year. The average is down from last year. It looks more like 2021. And, if there isn't a lot of realized volatility in the S&P, it's hard for implied volatility to go anywhere.
Mm-hmm.
And you can see that, visually on this one, as the S&P has climbed this year. The green line is 21-day realized volatility. And you can see that it has just collapsed. And the spread between realized and implied, whether you measure that with VIX or VIX futures, has widened. So you could argue that based on where realized volatility is, VIX and the VIX futures are too high, that they should probably come down even more. So there's still a meaningful premium, and that meaningful premium, for the intrepid investor suggests that, if realized is going to stay where it is, then I should be short volatility, not a recommendation. But that's what this would suggest to you, is that even if you think that volatility is lower than it should be, there's a case to be made that it can go even lower. Now, obviously, if the S&P, if there's some catalyst that causes the S&P to trade off hard and realize spikes higher, then maybe that premium's justified. But this is one of the reasons that there has been, a supply of volatility, people shorting vol.
Okay. Yeah.
Another way to look at that realized volatility is to say, okay, how often has the S&P moved plus or minus 2% in a day? And the answer this year is twice.
Wow. And we're
So,
in
you know,
August, so I mean, we've already had a good sample for this year, twice.
right. Well, you know,
That's
August,
amazing.
September, and even October, you know, can show some volatility. So we may yet, you know, get an increase in this. But, you know, again, even with all of the stuff that has happened this year, we just haven't seen big daily moves in the S&P.
Yep. Okay.
The last slide I've got, and I'm happy to, you know, answer any questions if anybody in the audience has any. I went and looked, you know, the recent high in the S&P was on July 31st.
Okay.
And, you know, through yesterday's close, it's down about 4%. So if you just take two of the common ways that people might hedge, right? One's buying puts and one is buying VIX calls. The SIBO P put, right, which is S&P exposure with rolling 5% out of the money puts. And the VXTH is the same idea, except you're owning the S&P and buying VIX calls. You can see that, you know, neither one of those has done you any good in this decline by the S&P. Because the decline, this is 2022 all over again. The decline has been so kind of steady and unvolatile that puts haven't paid off and VIX calls haven't paid off. You know, so you've paid for those pieces of protection.
Well, now
And
we
they haven't-
understand. Yeah, now we understand why people say this, that hedging is just a waste of money.
You know, and
They feel
you
that
talked, yeah, no, absolutely. And, you know, what you talked about, you know, short vol being a crowded trade. I would argue, well, and I would agree with that for a host of reasons. Maybe not as crowded as it was in January of 2018, but, you know, there's a lot of volatility supply from people who are selling it for one reason or another. The flip side of that is that long vol is a very uncrowded trade at the present time.
Okay.
Because, you know, hedges just haven't been paying.
Yeah, people don't want
and-
to waste their money. Why buy fire insurance if there's never a fire?
There's, you know, so I guess there's never going to be a fire, you know, but think about it. If you're an investment advisor, if you've got, you know, clients who are looking at their portfolios and you've looked at the wall of worry and said, you know, I want to have a hedge in here. And then your client opens their account statement and that hedge looks like, you know, a
hit.
A hit. Yes, indeed.
Yeah.
It is taking away value. You know, you're under pressure not to make that go away. And if you're an institution, you know, if you've got a committee that you got to report to, and they say, what the hell is this thing that's bleeding in our portfolio? You know, there might be some inclination to take it off.
The whole market's unhedged and short volatility is the view I've got. They're unhedged, which isn't great. And they're short volatility and they've been picking up silver dollars off the sidewalk for years now. Just when and if a steamroller comes. And I know you had meh after China. I would say meh so far.
I would be right there with you. You know,
And
one thing
banks meh, I say so far.
Right.
You know, anyway.
we're gonna see what happens with China. We're gonna see what happens with banks. We're gonna hear what Powell has to say this week.
What do you think? What do you think is bent is going to be biased to sound more hawkish, or is he going to give the market hope of a pause?
Well, That's a really good question. I think he's going to try to walk a fine line, splitting those two, because you know, if in fact they're data dependent, then you know what the market seems to be saying is we're going to be higher for longer.
Yeah.
You know, the S&P TLT has been terrible.
That's been your hedge.
Yeah, well, it hasn't worked very well, has it?
Well, I mean,
because,
being short bonds.
yeah. Oh, short bonds, yes.
Yeah, that's been your hedge.
Short
Being
bonds
short
has
bo-
been a good hedge.
Yeah.
Being you know, having bonds in your, if you're hanging on to that 60-40 portfolio, this is feeling like 2022 all over.
Yeah, and how could the banking situation be any better when it was about duration, and we're about to, you know, we're challenging the October lows in TLT.
Yeah, look, I think that's exactly right. I think, you know, you've got a bunch of banks who were given a reprieve, but still have, you know, significant mismatches on their balance sheets.
Yeah.
And that may come home to roost. You know, one of the things that I watch every day, literally every day, two measures of the credit markets. One is just, you know, spreads and yields. And obviously, if you're a high yield borrower and you need to finance something right now, you're going to pay a lot more than you did the last time you went to market. And oh, by the way, in the deal financing business anyway, the commercial banks have left the building. So if you want to finance an acquisition, as an example, and I have a lot of friends and clients in that deal business, you're dealing with vultures to get financing done. And you know, spreads still look reasonably okay. But the other thing I monitor is, and it's kind of out there. It's not something that too many people watch. And I have to credit Tom McClellan for showing me where the data is advance and declines in the bond market. The data exists for high yield and investment grade to see literally, you know, what the advancers and decliners are on a daily basis. And we've seen a lot more decliners than we have advancers recently. So even though spreads are holding up, you know,
there's pressure.
Yeah, bond guys seem to be lightening up.
Okay.
And if that starts to reflect itself in spreads, you know, hang on tight.
Well, Jim, I want to thank you again for, you know, really a great presentation on, you know, what's happening and how people continue to make money on this theme. And I wish you and the whole team lots of good fortune on your change after Labor Day. And we'll be talking in December. And I hope you have a great transition. It's smooth and that you take off like a mushroom.
Coach, I forgot, you're in Southern California, yes?
Yeah.
How was the hurricane?
It was wet. Not a lot of hurricane force winds where I was at, but about four inches of rain.
Yeah, wow.
In 9 hours. Yeah.
Yeah.
So,
wow.
Anyway, Jim, you know, not much can keep me down. No hurricanes or hits in the market, and even once in my life, cancer. So, you know, I'm still standing after all of this, and I'm ready for. I think we're in the eye of the hurricane right now, Jim.
We may well be, and I know you're ready for it.
I am, buddy, and I really great catching up with you, Jim. And you know, I'm a fan, and I know wherever you go, you're going to add value.
Peace to you, brother.
All right, Jim Carroll, everyone, you could still follow him at Vixologist. You want to learn about all the intricacies of vol? He's your doctor. Thank you, Jim.
All right. Thanks, Dale.
All right, buddy.
Bye.
Okay, everyone, you could join the team in 11 minutes on the morning edge. Good hunting the rest of the day. Don't just count your pips, count your blessings. See everyone tomorrow. Thanks for all your well wishes during the storm. Glad to be up and running. Adios.